advised to go ahead and contact someone that you care about that needs to obtain and maintain their economic liberation. You need to go ahead and contact them and tell them that they need to be tuning in to this Classroom Without Walls radio broadcast, because we have some information that will absolutely liberate you. We're going to be giving you information about everything to include cryptocurrencies and blockchain, okay? Many people got stuck last week when the government announced that they're going to put down possibly some regulatory constraints on cryptocurrencies. And cryptocurrencies lost $30 billion in 2 days. Now, if you've gone into that box, okay, we want to make sure the box known as cryptocurrencies extraordinaire, okay, well, we want to make sure that you don't get jacked while you're in that box. And we're going to go ahead and give you information that will allow you to monetize cryptocurrencies cleverly and the underlying technology that drives cryptocurrencies, which is blockchain. So I need you to take very, very copious notes and pay close attention now, because you will have no excuse, because we're going to give you what you need to succeed and get P.A.I.D. from all things cryptocurrencies and blockchain a little bit later on in today's Classroom Without Walls radio broadcast. But for right now, let's go ahead and really dwell into why extreme monetary stimulus simply cannot normalize markets. Now, central banks are promising to normalize, quote unquote, their monetary policy extremes in 2018. That's nice, but there's a problem, beloved. And that problem is you can't normalize markets that are now entirely dependent on extremes of monetary stimulus. You see, attempts to normalize now will break the markets and the financial systems, both near and far. Let's start with the core dynamic of the global economy and nosebleed valuation markets, i.e. credit. You see, modern finance has many complex moving parts, beloved. And these complex moving parts, they mask the inner simplicity of the economic system. You see, credit is the foundation of the current financial system, period. Credit enables consumers to bring consumption forward. That is, buy more stuff today than they could buy with the cash they have on hand, in exchange for promising to pay principal and the interest with their future income. Now, credit also enables speculators to buy more assets than they otherwise would, where they would normally be limited to cash on hand. Now, listen to this. You see, buying goods, services, and assets with credit appears to be a good thing. It appears to be a good thing. Consumers get to enjoy more stuff without having to scrimp and save up income, and investors/speculators can reap more income from owning more assets. But all goods, services, and assets are not equal, and all credit is not equal. There's an opportunity cost to any loan, as the income that will be devoted to paying principal and interest in the future could have been devoted to some other use or investment. So borrowing money to purchase a product or an asset now means foregoing some future purchase. Now, while all products have some sort of payoff, the payoffs are not equal. For instance, if I buy 5 bottles of $100 champagne and throw a party, the party is in the heady moments of celebration. However, if I buy a table saw for $500, that tool has the potential to help me generate additional income for years or even decades to come. You see, if I'm making money with the table saw, I can pay the debt service out of my new revenue and income that I make by and through utilizing the table saw. You see, all assets are not equal either. Some assets are riskier than others, with a less certain income stream or payoff. You see, borrowing to buy assets with predictable return is one thing. Buying assets with highly speculative returns is another, like cryptocurrencies. We'll get into that a little bit later on in today's Classroom Without Walls radio broadcast. Now, regardless of the eventual results of the investment, the borrower still has to pay interest on the debt, even if the speculative investment goes bust. You see, the basic idea here is the loan is based on collateral, that there is something of value anchoring the loan above and beyond the borrower's ability to pay principal and interest. Now, the classic example is a house. The lender issues a mortgage based on what the house can be sold for should the buyer default, and the lender has to sell the house underpinning the loan. Now, if a lender loans me $500 to buy a new table saw, and I default on the loan, the table saw is the collateral. Unfortunately for the lender, the market value of the used tool is perhaps $250 at best. So the lender loses $250 even after repossessing and selling the collateral. Now, if the lender loaned me $500 to buy champagne and I default, there is no collateral at all. The loan was based solely on my ability and willingness to pay principal and interest into the future. Now, lenders make money by issuing credit to borrowers. The incentives are clear. The more credit they issue, the higher their income. Now, giving this incentive, beloved, it's easy to convince oneself that a marginal borrower is creditworthy, and that's a speculative investment in a safe bet. This is especially true if the government guarantees the loan. For example, a home mortgage. Now, with the government guarantee, there's no reason not to take a chance on a marginal borrower buying a marginal house. If we take some home mortgages and bundle them into a mortgage-backed security, i.e. a collateralized debt obligation, a CDO, we can sell the future income stream, payments made by the borrowers in the future, as securities that can be sold worldwide to investors. Now, I can make risky loans, skim the fees, and pass the risk onto global investors. And this debt is now considered an asset to investors. See the sleight of hand? Now, these are the basic moving pieces of the credit expansion that has fueled both the recovery and the reflation of asset valuations, which have now reached historic extremes. Now, in response to the global financial crisis of 2008, central banks lowered interest rates to near zero to boost private sector lending and increase liquidity to enable private sector lenders and borrowers to refinance existing debt and generate new credit. They also bought assets such as government bonds, corporate bonds, and in some cases, stocks via ETFs, known as exchange-traded funds. Now, the goal here was to prop up the collateral underpinning all the debt. If liquidity dried up, consumers and enterprises would default, handling lenders' catastrophic losses. Now, as the crisis had crushed the market value of the collateral that lenders would have to sell to recoup their losses. And so, central banks pursued heretofore unprecedented policies aimed at goosing private sector lending and borrowing while boosting the markets for stocks, bonds, and real estate, the collateral that supported all the debt that was at risk or default. Now, all this new low cost and easily available credit, coupled with the central banks, the ongoing central banks' public messages that they would, quote, do whatever it takes, end quote, to restore credit mechanisms and reinflate the private sector markets for stocks, bonds, and real estate, it worked. The bamboozlement worked. Credit expansion and markets recovered, and then soared to new highs, as we see now. Now, while these policies accomplished the intended goals, boosting both new credit and asset valuations, they also generated less healthy consequences. Listen to me closely. You see, family members and listeners alike, by lowering interest rates and bond yields to near zero, central banks deprived institutional owners who rely on stable, high-yielding, safe investment income, such as insurers, pension funds, individual retirement accounts, and so on. And they deprived these entities of exactly what they needed, which is safe, stable, high-yield returns. Now, in this, quote, do whatever it takes, end quote, environment, the only way to earn a high return was and is to buy risky assets. Assets such as stocks and junk bonds that are intrinsically riskier than treasury bonds and other low-risk investments. You see, central banks are now trapped. You see, they're in the catch-22. If they raise rates to provide low risk, high yield returns to institutional owners, they will stifle the recovery and the asset bubbles that are dependent on unlimited liquidity and super low interest rates. But conversely, if they keep yields low, the only way institutional investors can earn gains they need to survive is to pile into risk assets and hope the current bubbles will lift even higher. You see, these traps the central banks are currently in is causing a strategy of pushing risk assets already at nosebleed valuations, pushing them even higher, as any decline would crush the value of the collateral underpinning the titanic mountain of debt the system has created in the past 8 years and handed institutional owners losses rather than gains. You see, as prior Fed chairperson Alan Greenspan would say, this conundrum has pushed the central banks into yet another policy extreme. To mask the rising systemic risk created by asset bubbles, central banks have taken to suppressing measures of volatility, measures that in previous eras would reflect the risk of extreme asset bubbles deflating. Now, how does this get resolved? Can central banks raise rates without popping the bubbles the system needs to remain solvent? Or can they keep yields near zero and keep pushing asset valuations higher for years or decades to come? Or is all this much more likely to end in a massive financial currency crisis? One characterized by default and liquidation of Americans' high fixed costs, heavily indebted households, and enterprises that have only stayed afloat by what? Borrowing more money. You see, this vast expansion of stimulus in year 8 of this expansion recovery is an unprecedented extreme. And does anyone seriously believe you can stop this flood and markets will normalize? Do you really believe that? Well, I tell you what, yours truly is going to buy a ticket and a bag of popcorn. And I'm going to continue to watch the markets. I'm going to continue to stay out in front of the markets and implement the appropriate strategies and techniques to get me P.A.I.D. in spite of what the market does or does not do. And in the meantime, in between time, let yours truly know whether or not the normalization that the central banks say that they could put forth, let me know whether or not that works. You're inside the classroom without walls, where we're giving you information that brings you out of the darkness and into the light.